one's the best crypto asset? Bitcoin's the best crypto asset. Which one's the best crypto asset? Bitcoin's the best crypto asset. Which one's the best? 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 What's the second best?
Welcome into Discover Crypto, a special live FOMC speech happening in just a few minutes. Jerome Powell is coming out to deliver his remarks to a market on edge. We also have an insane amount of companies coming out today, giving their earnings report out later on today. The markets are on edge as $9 trillion worth of market cap is going to lift the skirt and let the entire country and world know if they're still making money, man. We are up for some real chaos on the charts today. The return of easy money as the Federal Reserve is slated to cut interest rates. The tonality of Jerome Powell's speech is going to matter very, very much for how these markets move as the inflation storm ahead brews in the backdrop. And I'm joined by my illustrious co-host here, Kelly. Kelly, what are you doing here?
You know, this was you and me about 15 minutes ago. We crushed an entire extra large Papa John's New York style pizza and then had a couple slices from the next extra large while we were rocking some AI country remake of Eminem. So when I asked in the chat before we went live, if you can guess what we're doing right now, I'd send it $10,000, but it was so off the wall. That's what's going on. But we got a lot going on in the market today, man. It feels like that crux is hitting right now. Go pull us up side by side, baby. I got to be next to you on this one.
Yeah.
We got the Fed today, you know, and not only with the Fed, it's kind of already telegraphed. Is today even news, or is it getting out of the sentiments way of bull bear arguments of tone? Who freaking cares, man? And then beyond that, we've got Xi Jinping in China with Trump hopefully coming to a positive resolution there. And then, of course, remember that government shutdown is coming into really, really, really crunch time because we got a lot of the benefits that are going to sort of elapse during the shutdown, I think, on Saturday. So there's a lot of potentially bullish catalysts that could happen in the next 7 days. Not to even mention, we got major earning reports tonight.
Yeah, absolutely. Someone's asking, did we lose our longs? No. What we did is this morning, I knew some pain was coming. I could feel it on the Bitcoin chart, and the instructions for myself were basically to set the stop loss up in profit so I didn't get caught up by the absolutely vicious charts to come. And here we are. Let's swap me here. I lose my longs. Lost my mind. So basically the stop took me out in profit right there. And now we have rolled back down. Kelly has a good amount of macro data that I'm pretty excited to go over on Bitcoin. But the sentiment out there, Kelly, is this. It's looking major bad, right? From Jaku. Kelly, you know, there's a lot of concerns. There's a lot of fears in the market. I am at a situation right now where I'm kind of laughing at people that are hyper-focused on, oh my God, is it over? They're not taking advantage of the idea. If bears are correct, and if the James Wins of the world are correct, and we fall down to $60,000 Bitcoin, that's a $60,000 Bitcoin I can buy.
I don't see it happening, man. I don't see it happening.
Sounds too good to be true.
We got we have major things. I mean, we just talked about this a second ago, but this is what everybody's waiting on. This federal funds rate, 3 minutes away. 3 minutes away. And it hasn't been something that is just, you know, people aren't paying attention to, because all of us know this is what's been going on. This is Donald Trump. This is Jerome Powell right here. If you see exactly what's going on, it's just like, hey, man, hit those Fed rate. Hey, cut the rate. Hey, man, hey, Powell, cut the rate. And this is essentially exactly what's happening. And it's telegraphed in the charts, a near 99.4% likelihood of those rate cuts. So I don't think anything that happens with the rate cuts here in the next hour, you know, in 3 minutes actually, is going to move the markets. I think there's going to be chop in both directions, trying to catch people on both sides. In fact, we talked about this before. This is this morning's liquidation heat map. But what I want to talk about here is very briefly is we talked about this trap city. Now, let me go ahead and refresh this and notice what happened. Price came down and if this is actually bullish to me, came down, cleared this liquidity first before potentially making a swing to the upside. So the reason why this is important is because we see the federal fund rates. Remember that October 10th washout? See that red dip? That's when everybody went short because they thought it was over. Well, what happens when everybody thinks it's over? Oh, nope. Everybody's short. Let's go long. Boom. And I don't mean let's go long. I mean the market chopped those people out. And so now people have been positioning themselves for bullish price action. And not only that, notice this. Bitcoin is at basically near the lowest it's ever been for 6-month volatility, meaning this price action not really moving many dollars, many percentage points. We are at the most constricted level of volatility we've been in a long time. This is all while we're waiting on this Fed funds rate. So it's going to be interesting to see what happens here in the next couple of days with this.
Yeah, it's a situation where, a lot of market participants have been looking forward to this day, the return of easy money, the stop of quantitative tightening, and a move back to the printer, right? And now the interesting thing about this is that this is during a government shutdown, which Kelly highlighted before, which is getting near one of the largest government shutdowns in American history, right? So we're right around 29 days into this. Jerome Powell going to be making some interesting decisions without the government being open, a lot of those data sets not being available to him, but he gets a gist of it. Let's pull this up. So today, the Fed's going to cut those rates, it does look like, for the second time in 2025. All the government shutdowns have entered into the 29 days mark, and the data blackout continues on Jerome Powell. Honestly, he was purposely flying blind with falsified job data during the Biden administration as well. Then will be followed by a crucial press conference by the Fed chair. 1 hour later, Meta, Microsoft, and Alphabet all will report their earnings. That's earnings of 3 companies that are worth a combined $9.1 trillion.
Okay, we're waiting. We're waiting. It's pending. It should be printing here in just a moment. This Fed cut, whether it's 25 basis points or what would really jolt the market is a 50 base for. So, we paused.
Whoa! Pull up the charts. Oh
my God!
Pull up the charts.
We paused. I guess all that poking and prodding from Trump to Powell said, you know what? Am I too late, mofo? Well, then what do we see? We see.
Bro, are we shorting?
So here's the question. Does this impact Bitcoin whatsoever? I would argue that Jerome Powell has actually been doing a pretty reasonably decent job with the needle that he has to thread post COVID, post money printing, post all that. There's a lot of things on the line right now. So I don't think this impacts Bitcoin whatsoever. What would be interesting to see, though, is the S&P 500. And look at this. Look at the S&P 500. We're actually getting a pump out of this. And then this is interesting. We are in a tail of the upside down. But again, what did I say before all this happened? None of this matters. The market's been performing incredibly in the face of monetary constriction. Now, would it make it better for capital flow if the interest rates were cut further? Sure, in some regards, but it also tends to signal when something's broken. Is anything broken when you have the S&P 500 opening on consecutive new all-time highs? This is why it's not as easy as Trump saying, hey, Powell, you're too late. Well, is he? I mean, is he? What's your take on that, Drew?
Well, I know something that is broken. Amazon Web Services is breaking right as we're trying to get all of this data out of the Federal Reserve.
They broke their mic too.
AWS is going down, right? Is my mic still crazy? All right. So this is happening live time, right? Live. Amazon Web Services showing some difficulties. I do want to hop on over the Fed CME and just verify this. Absolutely wild.
Wait,
right,
did they
right
cut
here.
rates? I thought that said they didn't cut.
Yeah, go back to that. Go back to that last time that you were looking at. Let's double verify, because that would be an absolute shock to the markets to be pumping after
we
they
did.
held
We
rates.
did. We cut 25 basis points. Yeah.
Gotcha. Okay, Kelly. It's terrified so many people.
Terrified.
Oh
No, just looking at too much data. No, we cut. But again, whether they cut or not would have been no impact in my honest opinion about where the market was going. But that makes sense now when you look at the S&P 500 and you did see that spike to the upside. And
you
as
gave Web3 Joe a heart attack, Kelly. Okay.
The cut was 25 basis points as projected by the right here by the poly market.
Yeah. Okay. So all things are as expected. God, that would have been absolutely shocking. You
I'm
really
gonna find
got
a
me
window
freaked
real
out.
quick. I'm gonna find a way. I'm gonna go jump out the window. Hold on.
Oh man. Well, yeah. I mean, looking at the chart, it didn't look like they had held rates, right? So Bitcoin is flopping and groping down here. It's about to hit the 300 SMA on the 1 hour time frame. But let's go through a bunch of stories before Jerome Powell takes the stage, and let's get into what's going on here. So Trump talking about bringing back trillions of dollars to the United States. A great trip he had, dealing with very smart, talented, and wonderful leaders. Tomorrow, President Xi of China, and he put this out today, right? So he's meeting with President Xi of China tomorrow. This is going to be very, very important for markets. And he's planning to have a pretty good meeting. And there are signs that there are some concessions happening on both sides. We did see China and America work out a pretty good deal in terms of soybean trade, and things are looking a little bit more bright in terms of this trade war having a chance to cool down. Golly, it's going to take me a while to calm down from that. Motivational.
It's gonna take you a while for dude. And that was my fault. I was going between 7 different tabs, and I went over there. I'll show you what I saw. I'm just an idiot. I'll call it out. I was an idiot. I saw 4, and then I saw, oh damn, it's only 4, but that's the 4.
We're definitely cut.
So you know what? Too much data, too quickly, cutting between things. So again,
too much pizza.
Dude, we had a full extra large by ourselves and pizza slices from the next one. So
I want to cover some world
rate
trade
cut did happen. Just to clarify, we already clarified this, but we'll do it one more time. We did get a rate cut as expected, 25 basis points. And this is again exactly as has been intended, and the market has likely already been pricing in. I don't expect a huge amount of pressure out of this. Remember, we still have 25 minutes until the Jerome Powell's speech, and the tonality is going to be really what is key here. Even if we pause today, that wouldn't have mattered. The tonality of what he says is what everybody's looking for at 2:30. Why? Because at 2:30 he can either talk about the the reinitiation of some quantitative easing, rolling off some of the Treasury general, some of the buybacks, softening their stance on pulling money out of the market. There's a lot of different talking points that he's going to bring up at 2:30, which is going to give a lot more forward-looking information as to how investors are going to position themselves or deposition themselves.
Yeah, let's check out how the alts are reacting, though, brother. So, official Trump token up 18% now, up 45% on the week. Is this written in the stars? Trump token is up 45% on the week. Something's up here. 45th. Now it's going to be 47% up next. Zcash still on its war path here. Pi token, my scam token, I completely forget I hold, is up by 37% this week. That's kind of crazy. World Liberty Financial, Trump's DeFi and crypto play for his family, is also up. You know what? A lot of new projects are up right now. This is actually looking pretty healthy. And the one, I got a deep dive on all of the reasons why Aerodrome is doing so darn good. A lot of older projects are really having an issue reclaiming moments in price action that they had previous to the Binance liquidity poll chaos, and it was really like a mass exchange liquidity poll because it wasn't just, Binance involved. So Chainlink is one that's obviously on my watch list here, 18.3%. Cardano's slowly slipping back to 50 cents. It feels like every time I look at Cardano, it's just getting closer to a half a dollar here. Might have to call it, what is that? Double quarter Cardano. And then Solana is right under $200 right now. Solana's overall chart is actually one of the more bullish altcoin charts out there. And a lot of people hit me up. They're like, all right. So I will admit, like, I've been going pretty hard against the baseline thought process of what XRP was going to do. And I've been going into enemy fire, right? So people are reaching out to me. They're like, what is actually going on? And I feel that Solana's here to stay. I feel like Chainlink is here to stay. I feel like Ethereum and Bitcoin are here to stay. Many of these other altcoins are jockeying and positioning for their spot at the top of the table. But in tonight's 7 p.m. video, I'm going to show you what's actually happened behind closed doors, the valuations that are happening. And there's a bald guy that's probably going to be in control of half of all crypto movements here in the US over time. So make sure to stay tuned for that. I'm super excited for the video, and it involves a project that I've been looking at and got into very, very early that's been treating us very, very good. Now, you got a buddy here, Caleb Franzen, and I felt like this write-up was very good, Kelly. He's talking about October 10th lows, the S&P 500 outperforming Bitcoin by 7.9% versus that 5.6%. Now the NASDAQ 100 is outperforming Bitcoin, right? So there's a lot of mutedness, and this kind of plays into that coiling that you had called out earlier on in the show, Kelly, where the volatility is very, very low. People are looking at Wall Street going to new all-time highs day in and day out, and Bitcoin is just lagging behind. But this write-up from Caleb Franzen really puts it into perspective. He considers it malaise on a relative basis in environments where risk appetite is strong and increasing. He's pointed out before there's periods of underperformance versus the stock market, and that have more often than not produced a next leg higher for Bitcoin, both on an absolute and relative basis. He's been and remains patient in this scenario. The longer it takes, the more concerning it becomes, though. So this is something important to keep in mind. Why is it happening? Don't know. Even if I didn't know, what good does that accomplish? The back test over the past few sessions feels normal to him. Rejection at the AVWAP from the all-time highs, something that he pointed out in advance. And yeah, I could feel it. My wife looked at me in bed that night. She's like, this is a local top. I'm like, fine, I'll go tell the crowd. Hated it. She's such a good price oracle. The further proves that the importance of breaking and closing above that AVWAP shown on the chart in orange. So the upper band is the AVWAP. On the upper band, breaking out of that would constitute a new breakout pattern, especially if we attempt to use the 21 and 55-day EMAs as support after the rebound on the 200-day EMA, which is in the green here. So still view the price action as constructive. And I've been saying this, but he does it in a much more elegant way. The pullback makes structural sense for what Bitcoin's bull market usually looks like. So it is a scary time for some people. It absolutely is, and I acknowledge that. I empathize with that, right? Because a lot of people, maybe they came in when the hype was really high in December. Maybe they came in March or early 2024 when that NVIDIA hype was going on, and have had to go through a trade war, right? A trade war, muted markets. Can you show me the correlation between the S&P 500 and Bitcoin more specifically so we can kind of visualize this and give a greater context for it here?
No, absolutely, because this is very important, because on the one hand, we tend to have pretty strong directional correlation within the S&P 500, the SPX here, and Bitcoin, which is orange and blue. And so this is SPX, S&P, the stock market essentially. This has just been running away. Now, in this case, it ran away while Bitcoin was sideways for 7 months. But then you got a snap, bam, snapped up from 48,000 to 109,000. That's right, 48,000 here to 109,000. That's more than 100% growth, more than a doubling on Bitcoin's price action. So in this case, what are we seeing? A very similar correlation in terms of time frames. What we saw here, we're seeing now here with about 160 days where the price action is just moving. It is moving so aggressively up. Risk assets, tech is just running away, and yet Bitcoin is just remaining flat here. It feels to me more like the bigger players are here. We're at a key level in Bitcoin around that $120,000 region. Many old players, I'm talking people that bought in 2009, 10, 2011, 2012. There is some rotation of capital, and we know this to be the case from those old holders to new corporate institutional players. Why do we know that? Because on a daily basis, and on some weeks, we're seeing institutional purchases, the news, the headlines, $1 billion worth of Bitcoin purchased today, $2 billion today, 3, and then you see the price action. Come back to my chart. Then you see the price action going flat while we're getting these multi-billion-dollar buys. Well, where are they buying them from? Remember, that term OTC means over the counter. It just means person to person. So you're seeing these large, older players realize some tens of thousands % in profit and giving those Bitcoin, selling those Bitcoin to in large tranches to big institutional players. That's one of the reasons why I think we're seeing a lot of capital movement, but the price is remaining relatively flat because that buying pressure isn't affecting demand in exchange. But that's going to come to a close at some point, and I do believe we're going to get another one of those snap twos where we, tap up to 126. We could hit 150 within 2 or 3 days after that. So I think we need to be patient here. The 10 biggest days of every cycle happen without you when most people don't expect it, and so we just got to let every piece of the puzzle put itself in place.
And when I said, people that are hyper concerned right now, they probably bought at local peaks. I do want to know, because I see some people coming in, they had bought in December last year. Let me know when you got into crypto. Was it this year? Was it last year?
What's your
I want to get a
born
good
date?
feel.
Month and year, and what was the coin that got you in?
Yeah, I mean, let me know in the chat. I just like to know where people's mindsets are. We did have breaking news. My Mr. S Quant let me know about it. Okay, Mr. S, I didn't meet you in Vegas. We ran into the wrong Mr. S. I'm mad. It's a psyop, and I'm going to fix it here. So this is from Watcher Guru. The Federal Reserve set to end quantitative tightening beginning on December 1st, right? So this is just breaking news right now as we're live. Things are looking like the printer is turning back on. If we must, I must show you this. This is my favorite chart in crypto. This is why so much quantitative easing is going to come in. This is why the government is basically going to pour gasoline on the fire of inflation, trying to fix these banks that are underwater by hundreds of billions of dollars right now. And there's a lot of things at stake. There's undeniable that these are very, very trying times on the psyche. If you don't have a good baseline, a good thesis long-term of why you're in crypto, why you're in Bitcoin, then it's going to test you. You will be tested. And you know what? Even if we break out today and we go to $130,000, $140,000, you're going to see $10,000 to $20,000 price swings up and down within the continuation of a bull market. So, careful what you wish for, because as the price moves up, things get more and more heated. And I want to kind of fly through a lot of things. We have about 15 minutes before Jerome Powell does go live. I also wanted to highlight this. Michael Saylor stole my meme. So robots are going to want your Bitcoin. Now, this is a concept. Why would an AI, a robot, accept fiat currency that the government simply can print to dig itself out of problematic systems? Problematic monetary theory in AI that is doing work wants a product that is a proof of work, which is Bitcoin. And this is a very based picture. I wanted it to be my thumbnail, but I decided against it. What in the world is going on here, Kelly?
Oh, sorry, I was just doing my robot.
Okay. Oh my Lord. I saw it on the side of my eye. And there's a lot of people that are giving up on this market right now, which I find absolutely incredible. I do want to know, I saw this post and it's a really good question, right? If you're coming into some money right now, you see the market where it's sitting and you actually have an inclination to get involved, to take that risk, what would you buy, right? The options: Solana, which is, in my opinion, here to stay. It's coming after the new design of the internet, the new design of money from multiple different facets, with its staking, ETF approvals just happening, meme coins, AI agents. Then you have Aster, which is the decentralized perpetuals, decentralized trading. Sui is a very interesting project, has a very interesting meta, because Sui was actually developed from engineers that were originally part of the Facebook Libra token. So this Sui team knows how to build a system that can handle 1 billion users. I find that intriguing. I got in on the test net. I've been pretty dang bullish on it, and I'm a pretty selective altcoin enthusiast. I've liked Sui this whole time, even from testnet, right? Tron with the Southeast Asian market stranglehold. BNB, again, a Southeast Asian stranglehold, but a little bit of acceptance within the American markets coming, it looks like. Then Chainlink, the baseline oracle. This is the oracle that transfers data from blockchain to blockchain and essentially makes the entire crypto ecosystem interoperable. This is where Chainlink comes into play. Hyperliquid aggressively fighting against Aster right now to be the top decentralized perpetuals exchange. Tron, which comes from the Telegram app, and now is its own blockchain, and that has over 1 billion users on it as well. Or Avalanche, coming out of the left field with RWA integration. They do have a pretty budding meme coin ecosystem. I want to know from you guys, what would you dump $20,000 into right now? Right? I want to know about that. Let's check out this mention here. First purchase, January 8th, 2025, my daughter's B-Day. Hope to make a better future with my family. Been following Bitcoin and crypto for a couple of years, but wasn't convinced until this year. Now, Kelly, remember when we were talking to the Cardones, and we're sitting at probably $100,000 Bitcoin, and Cardone's like, that makes more of us with huge wealth more interested in Bitcoin if it's over $100,000. What is your take on it now? Because you talk to a lot of large institutional players, definitely the Cardones, and that really struck me when Cardone said that, because I was like, I got into Bitcoin like $4,000. Now it's $100,000, and I'm sitting here, hammering longs in above 100K. I'm definitely using a stop loss from where I came from. Can you kind of give your take on that? Like, now that Bitcoin's matured to this price level?
Absolutely. I don't think the $100,000 is the key marker. I think the $100,000 Bitcoin is a distinctive factor as it relates also to the time. Bitcoin came out in January 2009, and it took a lot of trials and tribulations. The entire global financial structure and governments were in financial cartels, were essentially lined up overwhelmingly against Bitcoin until the pivot happened with Larry Fink posting an application for the Bitcoin ETF in June or July of 2022, I believe. Mm-hmm. Those all went live January 2023. So the $100,000 mark, we all need to realize as retail, big money doesn't look at an asset relative to the dollar value of that asset. Berkshire Hathaway type A stock is like $800,000 a stock. But the dollar value of the asset is not relevant unless you look at the legacy of the asset. If you look at the fundamentals, how it's going to be integrated, how much growth does it have, and ways it can be integrated into the future, and what level of adoption is it at, and where does it sit within the regulatory thresholds that could limit or support it. And so Bitcoin at $100,000, the interesting fact about that is at that point, it has had, a decade plus. It's got the biggest financial institutions in the world that are at least aligning alongside Bitcoin, creating Bitcoin products. You have banks that are lining up to get involved with stablecoins, and you have governments speaking on a daily basis about strategic Bitcoin reserves. So is Bitcoin high at $100,000? No, Bitcoin's just getting started.
Yeah. It just, something from my perspective, it was, it made some lights go off in my head when I heard the Cardones talking about it that way. Now, we did have some news for the alts before how long do we got? We got 10 minutes until Jerome Powell hits the stage. Let's cover the altcoin stories before Jay Powell sends some nasty, nasty candles and captivates our attention with those price moves here. So Ben Grossman, he's marketing, I believe, at Ondo. He's talking about they're excited to bring Wall Street to BNB chain. It looks like an integration of Ondo into BNB chain, and bringing actually tokenized stocks and ETFs over with it, all powered by Ondo. Ondo is trying to take a giant bite out of a system that's been in place for a very, very long time and handles quadrillions. And yes, there's going to be speculation, I'd say, on things like Ondo. I personally, I've been kind of getting tomatoes thrown at me lately, because why would a system that's been around for this long, that controls this amount of money, simply open the doors up to a private organization and just let them handle the blockchain? It's a similar situation to JP Morgan building out Onyx blockchain. Yes, JP Morgan building an Onyx blockchain for years now. And when I am looking at this from a objective point of view, a bank and a Wall Street sector, they want to retain control. And it is something to see tokenized stocks come to the realm. I am bullish on this idea, but the absolute takeover of Wall Street by Ondo is not something I'm looking out for. I think people will speculate on this, but Kelly, does this news spark you in terms of a bullish expectation for Ondo? Like, I know I'm kind of the I mean, some might say I'm a bear. I'm looking for like $3 or $4 Ondo, right? In this cycle. Like it really, it's been very lackluster. It's lost more than most. It gains less than most when the market returns. What's your take on Ondo right now, Kelly?
My mic is muted. My bad.
Yeah.
I think Ondo is a good project. I do think that it's entered a very competitive space in that Avalanche is launching tokenized assets. Solana just launched internet capital markets or whatever on the New York Stock Exchange in partnership with them in some regard. You have Injective that's also listing tokenized securities and assets. Now, does that mean Ondo's done? No, I think Ondo's still going to perform, much like I'm not a big fan of XRP, but I hope everybody that holds XRP, I hope you make money. I think Ondo's still going to have a nice speculative run. I think it's still going to, break above 250. I think it's going to go above 3 somewhere. I'm in agreement with you, somewhere between 3 and 5. So the question is not why are they talking good or bad about Ondo? Ask yourself, what's your time horizon? If you're trading it for this cycle and you're in it and you're underwater, that doesn't mean cut it, because most people lose money in cycle. I've been in 3.5 cycles now. Most people lose money in this market because they hold something and they see everything else moving. Cardano did this last cycle and the cycle before. Everything else is moving. And so people go, I'm done with this. They get out and they get into other stuff that's already been moving. Now that stuff dips and the asset they just got out of then absolutely takes off and they go, damn it, why wasn't I more patient? So with that being said, if you're deciding that you want to get into Ondo because you think it is the tokenized asset play, it might be, it might not. It's a very competitive field. And I agree with you. I think NASDAQ and some of these other major stock exchanges likely will also post their own chains that are tokenizing assets as well. So are you going to get out of it if you're underwater? I wouldn't do that. I'd wait for it to get back positive and realize some profits. But I wouldn't reposition because of that either.
No, those are fair words. Fair words. I guess I'm just an agent of high conspiracy, and if I'm, the Wall Street Stock Exchange and a private company comes to me, sure, you can dance at the ball together, learn their moves, but you can also hire your own cryptographic designers and engineers and produce the same type of product outside. I'm just saying, okay, don't throw tomatoes at me. Now, this former FTX US president is going to launch a perpetuals trading platform on stocks. I'm actually of the opinion that this is probably going to find a good degree of success. A lot of people don't know how insane the FTX crash was. A lot of people don't understand how much arbitrage was done with them, and FTX employees and C-suite level people funding Democrats and Republicans for political favor all along the way with your stolen money. People have a slow attention span, so this is probably actually going to launch pretty decently. Senate Democrats are also moving in tandem to condemn Trump's pardon of CZ. They say the crypto industry executive getting a free pass after a guilty plea sends the wrong signal. You know what would send the right signal, Democrats? Why don't you send all of the money back that you stole from us and we're receiving giant paychecks from FTX officials for, a no action relief from the SEC? I'm sure that the SEC is closing their eyes and giving you a blind action-free event right before your gigantic Ponzi scheme came down on your heads, had nothing to do with all the money that you sent to these politicians. Democrats need to send the money back. Republicans need to send the money back. It's an absolute scam. We got 5 minutes till Powell is speaking here, so I'm going to fly as fast as I can. Here's some information on Clanker. Told you guys I'd start investigating into it. A Clanker perp market will now enter halt mode on Coinbase International Exchange and Coinbase Advanced. Users can post cancel limit orders, but there will be no matches. The market will remain in halt mode for a minimum of 1 minute. So we saw this in Coinbase markets. Clanker perpetuals having to be halted. Absolute chaos breaking out there. Now, a lot of things are going on in Base, the X402 ecosystem, which we've been covering since it came out. It's a gigantic AI agent economy. Paul Barron actually feels like
on Base too.
Yes.
You wonder why Aerodrone's performing well. People are getting positioned in an ecosystem that is only getting stronger.
Yeah, absolutely. And this Coinbase is coming at the crypto world from 100 different angles, which is again why I feel good about Solana. And Mr. S put this out, Solana plus Van Eck, and this is staked ETFs being ready and some of them being approved here in the US for Solana. I think Solana is positioned for the long term. Now, there is another channel that is called DeFi Crypto and Airdrops, right? DeFi Crypto and Airdrops, they look into a lot of new protocols, but also the mechanics of how to get involved in DeFi and earn active yield. Now, Veteran Crypto runs that channel along with Jeff, and they're going to be doing a deep dive on GliderFi with Jeff this Friday. Tag me in it, so I'm definitely going to be catching that.
My name is Jeff.
He's such a badass dude, though, too. I met Jeff in the office. Very, very based individual. Very, very based individual. Drew the gelled up mullet look. Oh, it's not really. It's just, it's just a little wet.
But guys, gals, friends, countrymen, we've got. I just want to before we get into it, we've got the price action is right at a key juncture. I just want you to notice something. We have the price action came down and has tested this, the scene of the crime, the area in which Bitcoin broke out of this symmetrical triangle. It has come back 2 points of interest there. The rising level of support, falling level of resistance. We have tested that. We have the Fed, all these talking points, which they're going to be going over live in this press conference in a matter of moments. I expect to see Bitcoin. It does not need to hold this. Remember what we have seen for the better part of 3 years, and it's only gotten more excessive in the last 6 months. This area, although this should bullishly hold and bounce, even if it's going to be a bull, very likely could wash out down, come back up, trick people, wash up, bull trap, and then make a move. Watch for the double chop your mother's face off moves in these charts, which keep happening. I just wanted to make sure I told you that.
Oh, yeah. And also, Blue Whale Shark.
You are banned!
Yeah, just had to get it in before Jerome Powell comes on live here. Now we are 1 minute away. Kelly, let's go ahead and bring up the stage for Jerome Powell. If we can, pop it on up there. For some reason, I'm blocked from that, but let's add this too. Everyone's waiting and make sure we got sound here. Let us know in the chat. Can you hear? They're not making much noise right now.
Yeah, there's no audio coming from their end yet. But
all right, so we'll keep an eye on this. Now,
here he goes. Here he comes. Oh. Can we hear him? There we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated.
This is a 1 minute chart, guys.
In support of our goals and in light of the balance of risks to employment and inflation, today, the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, Available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so,
Everybody type what you think is really going through his mind as he's saying that. So it's be curious to hear what you think is actually going through his mind.
our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level.
Short-lived.
But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored.
Bitcoin
Our
dominance
success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Oh my God. We're dropping like a rock. We're dropping like a rock, folks. Hold on to your
Wall
lines.
Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that that needs to be taken on board. We had, just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook? Or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, others people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire.
Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But this is, I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just
Noah,
ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we
That's
look
plummet.
for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars because, again, with the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
There's the bounce. Alts are doing pretty good in relativity right now. Alts are doing pretty good.
Thank you.
Hold
Colby
on.
Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's I guess 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
JXRP.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
No strength on the RSI.
So I was referring to the discussion about, to the extent it related to December. You saw we had 2 dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing. It has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
John L.
Shrinkage.
Janelle
It's
Martin
real.
with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation, but we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments, but so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be 5 or 6 tenths, and so that if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further, but it is that it will be a one-time increase. And, we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that? And especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And, overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because the Fed policy is modestly restrictive. So that should also help get that. I want to say, though,
It's always right
we're
at the trend
absolutely
line. Look at
committed to
that.
returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an
This is
excess level
important.
of investment there or market bubbles?
This is
How is the
important.
Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. And big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Man, you ain't got any idea about the economy as using fake data.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data, that isn't the gold standard, or that you're relying on your own surveys or the beige book, do you worry at some point you're going to have to start making policy by anecdote?
You know, this is a temporary state of affairs, and, you know, we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it, and that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that you know, what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, you know, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things you know, that we're watching very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do.
That's a bull flag, right?
We're watching that very carefully, and you know, yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of, you know, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
That bold-faced lie. Bold-faced lie, AI is going to create jobs.
Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, you said far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then? Well, the perspectives of people on the committee that, you know, we've now moved 150 basis points, and that we're down into you know, you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you know, you can argue these positions since it can't be directly observed, the neutral rate. So, you know, I think for some part of the committee, you know, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, you know, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views. So on that division, then you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have in fact cut 2 more times. And we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now.
CGI, man, I'm telling you.
Maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Telling you. Old-faced lies.
Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing. And then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment,
Even the dog's bored of him.
on a sustainable basis, doesn't, if you're creating 0 jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So I thought, and many of my colleagues thought, in fact, you've seen the last 2 meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. So it's a complicated situation.
It's going to get worse.
Some people argue that this is supply and we really can't affect it much with our tools. But others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are 1/10 or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are they stop generating inflation. You've had a one-time price increase. As long as you're not at least this is the theory, this is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up, they'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because, you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Sales tax on money that I was taxed on
From
earning,
Bloomberg Television and
pay
Radio.
higher prices on
Do you
goods
have
that were
any
tariffed and
concerns that
increased prices.
equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable, whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good.
Pretty good.
You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases.
Take this man's
And I wonder how
microphone.
you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring. And that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why we're going. That's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models, and and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that and has been growing and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher-end consumers or maybe skewed that way. But the consumer is spending, and that's a big, big chunk of what's going on in the economy, substantially bigger than AI. You could point to growth. I mean, actually, growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs because there isn't this flow into the pool of labor that, where people need jobs because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course, that will reverse. But, you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian. Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report.
Stupidest comment of the day right here.
But we look at, the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really I mean, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is the, you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular
that we're
section
thinking
of the
of?
labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, yeah, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney. Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this. And I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously, we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
Oh man, that felt like it took absolutely forever. He essentially, let's just kind of recap what he said. We got a Fed interest rate cut. Okay, we got a Fed interest rate cut. Yes, 25 basis points. Beyond the 25 basis points, there's also potentially, it's being telegraphed, almost said, that it's very likely we're going to get the end of quantitative tightening, the end of QT, which would mean they would stop pulling money, basically reducing their balance sheet. Okay, so what that means is, one, they had a huge sort of debate back and forth of, yes, we're going to end QT, but also it's not guaranteed that we're going to end QT. So that was a very major shift in talking points of everything that has gone on, especially leading up to this. And this has all been telegraphed even before we went live. This was posted based on their conversation and the initial release. Basically, economic activity continues to expand, a moderate price. We know that inflation has moved up since earlier in the year, remains somewhat elevated. We know that it's about 2.7. Committee noted that downside risks to employment have risen in recent months. Now, that is true, but there's also a sort of inflection point that nobody's really sure about with the advent of what's happening with AI jobs and potentially displacement or replacement of human workers with AI. We're already seeing massive reductions in a number of different companies like UPS, like Amazon, a number of other companies out there that are basically removing jobs and replacing them with AI. That's going to be interesting to see how it goes. But that's not the specific thing they're talking about when they're talking about the labor force, because there's still plenty of other jobs that they're watching when people are losing jobs versus not. Because remember, their dual mandate about keeping inflation at bay while also keeping people in work. The Fed will also conclude its balance sheet reduction. That's quantitative tightening, constricting what they're doing. And in order to do that, if they're reducing balance sheet, that would be selling on the market. That's why this is so important. So if that's going to be the case, if they do wrap this up December 1st, this means that this could be bullish for risk assets in the market. Now, when we come over here and we look at the dollar, yes, something is pumping today. Powell pumped the dollar. Look at this. Nice. And again, this is a 1 hour chart, but that's a pretty big move for the dollar. I mean, look at that. That's about 0.7% of the dollar index. Now, what we're seeing right now, this is very important on the dollar because everybody wants to know, are their alts going to pump? Is Bitcoin going to pump? Well, seeing the dollar as it is right here, where it's rounding out like this, we, yes, are in this constricted area right in this zone. But if we break out of this, this would be ultimately very bad based on past relationships of the dollar and risk assets. If the dollar does break up and out of this, that's going to likely mean a pretty long bearish or constricted sort of market structure going into next year. If this does not find its way all the way up to, maybe not even up to this level, but if this rejects anywhere in here and comes down, and this level right here, all eyes are on this level right here. Why am I showing you this chart? I'm going to show you right here. And it is not that. It's not that. Where is it at? It's right here. This is Bitcoin's price action as it relates to the dollar. Look at the previous cycle top, previous cycle top, previous cycle top. Okay, what is the white line? The white line is the dollar. Look at the shape of this. The breakdown into this, form a base, bottom, and then boom, come up. This bottom where the dollar fell into is at the same sort of time frame that you're seeing this parabolic increase in Bitcoin's price action. Dollar collapsing, parabolic increase in price action. We found a bottom, made its way up. We had a bear market. Here we go again. We had a collapse. The confounding nature of this is that we never got that really big run up. So everybody's debating whether it's a 4-year cycle, whether it's a risk narrative, whether it's the never ending back and forth of tariffs, not tariffs, geopolitical conflict, the government shutdown. But we have all these capital structures on the outside now getting access to Bitcoin. It should be pumping. And we have not gotten that. At the same rate, we also saw a massive reduction, a massive fall in the dollar value right here. But this structure, these structures are looking very similar. That do suggest we potentially could have put it in the top. However, I will say we do have this very, very important trend line that we need to pay attention to. And that is this line right here that we had highlighted right there. Boom. That is an 18-year support trend line. Trend lines at some point will get broken. If, I'm not saying this is going to, but if this were to break down from this, this would be monumentally bullish for Bitcoin because it's not only coming down, riding on this level right now where the price is not really moving. And look, the dollar's also not really moving. It's sideways chop. If this area were to break down, this has been all the way back here since 2008. So that is pretty darn major, if you ask me, considering what we're seeing. If this were to break down, that's not the only thing we're paying attention to, though. We also see S&P 500 has been melting to the upside. We've had that's the 3-day, go back to the daily. We have these gaps where this is just gapped up, and never filled those gaps, And here, yet again, we have another gap here, a little bit of a rollover on the news today. But what did I mention before the Fed, before we got the rate cut distinction, but also before Powell spoke? I talked about on this specific chart, let's go ahead and delete this 3-minute, let's go ahead and delete this text. We talked about the potential for this to whipsaw in 2 different directions. So far, we got the whipsaw down. We talked about that being a major possibility. And then the next opportunity here is a potential trap up. And then the deciding factor is, does it continue or does it continue? Is it going to have a follow through to the upside, or are the bears going to take control and we're going to go a little bit deeper? As it stands right now on the 15-minute chart, which I would never make a strong trade decision off of, we do have weakness here. We do have weakness. Money flow coming out. RSI getting rejected around that 50-point line. But if we get out to like the daily, for instance, notice we have come up and we are at a very critical juncture. Very critical. Look at this. This broke above the 50 line. got rejected. Now we're right back in that same territory between 46 and 52. This needs to pick a decision of what direction to go. This week is still very important. This week is very important based on what happens with China's dealings with Xi Jinping, but then also what happens with this government shutdown. I have this inkling in my bones that maybe our politicians aren't as corrupt as they think. Yeah, that's the, who am I talking? No, absolutely they're corrupt. But the pressures coming into November 1st, when SNAP benefits end, when a number of other, we're starting to see government federal workers like air traffic controllers amongst many, many other federal workers out there not getting paid. Pressure is coming to bear. I would hope for them, their sake at minimum, that the Democrats aren't holding the government hostage just to get all that unnecessary funding that is not part of the bills that Chuck Schumer wrote himself. So as that being said, looking at Bitcoin, zooming out, yes, we had the Fed interest rate cut today. We did get it. I don't know what happened with that snafu at the beginning when I looked at that chart backwards, but that was a funny moment in my life I will never forget. But the price action is still well within the zones that we've been watching. We have this basically sideways broadening wedge. This has come down and basically testing into the same range of liquidity that this has been in for quite some time. Same range of liquidity that this has been in for quite some time. If we come over and look at this chart right here, hold on one second. Let me pull it up. It's right here. Yeah. So we're kind of at that critical juncture, not only the multi-year resistance line that's all the way back here to 2021, April 2021, November 2021, projected out. We've had a lot of trouble around this range, breaking free. And in so doing, we have this rising wedge now, which do tend to break out bearish. What we do, we broke out bearish. We came right back inside. Now we're at the crux, rejecting currently at that multi-year, the multi-year trend line, as well as this rising level of support here that is now resistance. Although we have all these lines on the charts, to take a page out of Mike Alfred's books, these can be good guiding principles. They can give you some hope about setting up probabilities, but at the end of the day, none of that matters. None of it matters. You can build yourself a very key level of resistance that turns into a very key level of support. But the market makers that have gotten involved, the corporate players that have gotten involved, the countries that have gotten involved, the overwhelmingly, like, insanely rich pockets that are now getting involved are not looking at a fib. They're not looking at a support and resistance. They don't give a god darn shit about the 4-year cycle. They are buying or they are selling or they are looking to move the market and chop people out so they get better areas to buy or sell. They're not looking at the same data that you're looking at. They're also not looking at the same time horizons. So while all these lines are spectacular to give yourself a little bit of hope, to give yourself a little bit of a framework, do that. That's great. But do not actively trade your entire portfolio. If you're going to trade with very, very, be there for, do it with a very allocated portion of your portfolio, say 5%, maybe 10%. And as you build that up, roll those profits into your long-term hold bag that you never trade. Take some of those profits into your cash so you can spend in life and leave the rest. So like a third, and another third you put and basically grow your trading account. That way if you want to play the game, play the game. But remember, we are entering a monumental shift on the world stage right now about global finance, about the world order, about the new world order, about how technology fits into this new world order. Everybody's going to be clamoring to get into this asset class, and we're already seeing those things grow exponentially. So right now, de-stress yourself. Don't get locked in on an exact take profit, on an exact exit, on an exact 4-year cycle. None of it's really going to matter. Do you have conviction? Are you shaken out by the noise right now when you're seeing an overwhelming bullish landscape, whether it is within the next week or in 2 quarters? We need to pace ourselves. We need to be patient because the things that we're seeing in this market and the way it's heating up is monumental. And we have things like this that is only a couple of days away. Will bring back trillions of dollars to the U.S., but also bring back the narrative to risk assets, but also considering what's going on. Why is it so important? The government in the U.S. is now pro-crypto. Look at this nominal size of the GDP in the U.S., over $30 trillion. Now let's include Russia, Brazil, Canada, Italy, France, UK, Japan, India, Germany. All of those do not even make up what is in the U.S. Now, of course, this doesn't include China, but this is a major impact on the decisions that are made here. What happens with our strategic Bitcoin reserve? What happens with the market structure bill? What happens with the Clarity Act, the Genius Act? All these major globally dominant financial cartel cohorts like JP Morgan and Bank of America and Deutsche Bank and Van Eck and Bitwise. And I'm speaking about all these different major financial institutions getting involved with Bitcoin, with stablecoins, with crypto, with the rails of the future. It is happening right now. So we got today's story off our back with Powell saying the same thing he always said. The only key difference here is we do have QT on the horizon starting December 1st. We'll have to see how it plays out. But everybody, stay frosty. I love you. I hope you all have an absolutely wonderful day. Do not get locked in to this matrix with too much frustration. It will play out. It's proving right now to be the market that is there for the most patient. So take time, find opportunity, drive more cash flow, find ways to allocate, whether it's in stable coins. You don't always have to buy an asset. You can have it parked in stable coins that you have available when you do get big market crashes. But that's it for today, everybody. I love you. I'm curious, everybody in the live chat right now, before we go, and comment down below if you're watching somewhere else or watching later. Do you think we're going to have new highs in November? AKA, is October delayed into November? Is October, is it all just pushed back a month? Are we about to break to new highs at some point in November? Throw a 1 for yes or a 2 for no. I do think we're going to. I think we're going to have a move that comes out of nowhere here in the next, I would say probably 4 to 9 days. I think we're going to start to get pretty aggressive price action on the chart. But that's my speculation. Hope you all are doing well. I love you. I appreciate you. Make sure you're giving me a follow right here at Kelly Kellam, Kelly Kellam. I spell this out because there's about 100 fake profiles of me. I love you guys. I appreciate you. I really do want to make sure that you all don't step into the same potholes that I did early on, years and years ago when I first got into markets, especially when I first got into crypto back in 2015, 16, 17, because there's so much money to be made now. If you can be patient, do not get greedy. With that being said, I love you. Shout out to our channel partners, Bitcoin IRA. Make sure you're trading smart. And if you're not looking to the future, get over to bitcoinira.com. They'll put you on to how you can day trade many of your altcoins and rotate those profits into Bitcoin and not do it in this massive tax hit fashion. You can defer a lot of those taxes. Be smart. And also Arculus. Make sure you head over to getarculus.com. Use code DC20. That's D as in discover, C as in crypto, and the number's 20. DC20 for 20% off. The best crypto cold storage solution there is. That's all I got. And with that, I'll see you in the next one. Adios, muchachos.
We just wanted to take a quick second to shout out our sponsor, Arculus. They are a cold storage hardware wallet, helps you secure all of your digital assets for the future. Just tap this thing to the back of your phone and boom, you're in. We wouldn't be able to do this without them, but also wouldn't be able to do this without you guys, the Disco fam. You've supported us a lot over the years. If you want to support the channel now, just use the code DC20. It gets you 20% off this card. It's the #1 way you can support this channel going forward. Thank you for your support. We'll see you at the top.